Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning. I want to wish a happy Easter to everybody celebrating over the weekend. Happy Passover to those who are celebrating Passover last week, and the celebration goes on this week as well. So I hope everyone in this era of social distancing was able to enjoy some time spent with immediate family and perhaps utilizing technology to reach out to family outside of the immediate family in this unique period. I'm going to get started this morning. Lot to talk about. Saw a real big rally last week. Lots of commentary on that rally. Going to talk about that and give some insights with the move from OPEC with help from President Trump to reduce oil production. And we'll talk about some individual stocks from Barron's and some ideas that they had. And then, of course, we'll hear from Brad and some of his insights on the markets and some further insights on the bond markets, which have been as interesting as the stock markets have been. So, going to get started this morning and talk about a book that I think is timely given what's taken place in the financial markets in the world, both and this book I think can give us some assistance both personally and professionally. And the title of the book is The Subtle Art of Not Giving instead of the word that starts with F, I'm going to use the word crap. So The Subtle Art of Not Giving a Crap, we'll say, is the book that we are talking about. And was reading a synopsis of this book by a gentleman named Vitaly Katsenelson, and he provided a good summary in an email that he sent out. This is a book that I had read, and I think that it is timely, some of the thoughts and ideas that the author was trying to convey. And what he was trying to say is that caring or giving a crap about too many things, and this is something to really think about as many people are sitting home and focused on lots of things, but thinking about too many things or giving a crap about too much is bad for your mental health. It causes you to become overly attached to the superficial and the fake, and to dedicate your life to chasing a mirage of happiness and satisfaction. What we care or what we give a crap about is paramount, as it determines where we focus our thoughts and energy. This is what we use to measure ourselves against, and thus it is what is going to determine our happiness. Now, lots of psychologists may say that your happiness often is what you perceive as reality minus your expectations, and perhaps a way of adjusting that should be that your happiness needs to be modified to the current reality minus not your expectations, but the quote-unquote right expectations. So the author goes on to summarize and say the key to a good life is not giving a crap about more, it's giving a crap about less, giving a crap about only what is true, immediate, and important. We need to think about what is important to us, and then we will be able to filter whatever the external environment tries to shove down our throats. Whether it be in terms of news or marketing or advertising or neighbors or friends, if we are able to establish our own filtration system, we won't get absorbed and caught up in a lot of what may be nonsense or unimportant facts that we can get ourselves tied up in. In other words, we need to develop our own value system. So just to give an example of how we can get caught up in this type of environment, perhaps you're a college student and there's a list of the top 100 schools, or perhaps you're a financial advisor and there's a list of the top 200 financial advisors in your town, and you're not on that list. And suddenly you become very upset and angry, thinking about some of your colleagues, let's say in this list of the top 200 financial advisors in Peoria, Illinois, and you look at that list and you know 70 people on that list, and you think to yourself, I'm better and I'm more established than almost all of those people that I even know on that list. And you become very irate, angry, frustrated, and despondent. The key here is that if you never saw this external list and you never stumbled upon it, you never would have been angry about it. So you need to be able to filter what is important. Is that list truly important? Is that something that you should give a crap about? Or did you just suddenly become sucked in by news and media and focus on something because you saw it that really isn't important, relevant, and worthy of your intention? Unfortunately, we do this type of action all the time, often mindlessly. We're on autopilot. We let the external environment set the goals that drive our lives and eventually bring us to disappointment. Our values are our internal filtration, evaluation, and measuring system. If we can get the values right, then a lot of problems in our lives will take care of themselves. And this may be the best path to happiness. The key to focus on is what are your values, what is important to you, and to try and have the right values. Values, goals should never be a byproduct of things, but what we do should never be a goal unto itself. Give you an example of how things like material success can sidetrack us, and we can focus potentially on the wrong sorts of paths to happiness. Perhaps you've gone to Beverly Hills and you've gone on a family vacation. Perhaps you were the parent. Perhaps it was a long time ago and you were the child. And you are taking a tour of the stars' homes, and you're with a guide, and the guide is pointing out this fancy house, and this fancy house has a fancy Mercedes and a fancy Rolls Royce in the front yard. And we go from house to house, and we hear that this is the house where Al Pacino lived. This is the residence of Steven Spielberg, and over there is his Rolls Royce. And we focus on all of these material items. The message that we're sending, whether conscious or unconscious, as we go on this, what we see as a harmless, mindless, potentially divergent, fun trip, nevertheless there is a strong message that's being delivered that money and things equal happiness. And if money is the goal, you'll never have enough. With every additional tier or strata you achieve financially, if you're in a strata of millionaires, there's always a strata of the next comma, 10 millionaires. And when you graduate to the category of people who have $10 million, you'll find that now you're on the low end of a brand new category. And then you'll move up to 100 million, and you'll find out that you're once again thought that you had reached the pinnacle of success, and you're once again on the lower end of what some may deem as successful. So it's a constant rat race, a constant chase, and a constant reminder that materiality and money will not buy you happiness. If you have that value system, that filtration system of what it is that is important to you, you'll be able to not focus when your senses are subjected to societal pressures to focus on things that may make headlines, that are perhaps even fun and exciting, but are not necessarily measures of whether or not you're leading a fulfilling life. So with that, we're going to transition, think about that, and we're going to move on this morning and talk about the financial markets, which is a lot to talk about, obviously. We saw a record precipitous drop. We saw a significant bounce last week, markets up significantly. And Barron's had a bunch to say about that, and going to talk about that, and then I'll talk about some of the news this morning. So Barron's was concerned about the severity of the drop, but also about the severity of the upswing that we saw last week. And Barron's ran two articles expressing some concern about whether or not we're out of the woods. One of which was entitled, "Stocks Just Had Their Best Week in Decades, Now Comes the Drop." And when I say now comes the drop, doesn't mean that they're predicting a drop, but they're warning that we're not at the all-clear stage. They say telling investors to sell now in the midst of the coronavirus crisis feels a bit like yelling fire in a crowded room. Even if there are no crowded rooms anymore, still it feels like it might be the right thing to do. They talk about the action last week. The S&P rose 12%, its best week since 1974, and finished 25% off its March low. The corresponding gain for the Dow was 13%. It was up 27.8% from its low. The Nasdaq jumped 10.5%, 23% off its lows. And all of these gains came after the S&P had fallen 34% from its high in just 33 days. That kind of speed is unprecedented. May explain some of the stress that investors and financial advisors have been feeling. Put that in perspective, the financial crisis, as dramatic as it was and as terrible as it felt, it took 10 months for the market to drop 20%. Here we had 33 days, 34%. In the financial crisis, the market rallied for 6 weeks off the bottom before retesting its November 2008 lows. Compared with the COVID whirlwind, that action back then looks positively pedestrian. Some are discussing that still, like in 2008, we may see a retesting of the lows, and if we do see markets think about retesting those lows, and no one has a crystal ball if that will or won't happen, but nevertheless, just given the speed we've seen before, it may happen at an accelerating rate. We'll say that Goldman Sachs this morning, who has been fairly robust in their market prognostications, this morning out saying that they think that we have seen the lows of this crisis, perhaps giving some strength to futures which have rallied back from their worst levels of the morning. Barron's also talked about the fact that we're going to see some really awful GDP numbers as financial numbers start coming out for the quarter that just ended, and they talk about how we may react to those numbers, and that's one of the reasons that they think some concerns remain warranted. The worst prediction comes from a J.P. Morgan economist that estimate that U.S. gross domestic product could fall as much as 40%. That's a revision from their initial prediction of 25% that they had said. So this morning we're looking at futures on the Dow down about 74 points. S&P futures down about 9. Nasdaq futures down about 25. Oil is the item that's getting the attention. Yesterday on Sunday, the OPEC Plus group, which includes the United States, Mexico, Russia, announced historic cuts, 9.7 million barrels of production cuts. The sticking point was Mexico not agreeing to 400,000 of cuts that the Saudis had requested, and it turns out that the Mexicans weren't as keen to cut production because they had hedged most, if not all, of their production. No one knows exactly how much, but they were not nearly as susceptible as many of the other producers are, including the producers here in the United States, to falling prices. The agreement was reached by President Trump agreeing to make up the Mexican shortfall. Mexico only agreed to cut 100,000 barrels by cutting production here in the U.S. No one is exactly sure how he's going to enforce that production, so devils remain in the details, and whether or not these cuts of 9.7 million barrels materialize will be seen. But nevertheless, markets taking it as a indication of some cooperation. Oil's only up 9 cents this morning, but it did rally significantly last week, and the concerns were if a deal wasn't reached by Monday morning that oil would sell off significantly, and that would be something that could drag the markets lower. Ironic as it sounds, we've talked about the fact that just 10 or 15 years ago, if we were talking about oil prices collapsing, we would have viewed that as an extraordinarily positive event. Taking a look at the bond market this morning, we are seeing yields slightly higher across the board, but still at very low levels. We're seeing the 3-month Treasury, which was negative just about a week ago, all the way up to 25 basis points. The 2-year is at 23 basis points, and the 5-year is at 43 basis points. So basically, almost no difference between the 3-month and the 5-year. 10 years at 75, and the 30 years 138. We're looking at yields up anywhere between 1 and 3 basis points in the Treasury markets. Taking a look overseas, the Nikkei was down 2%. The Hang Seng was closed. The Shanghai was down 0.5%. Also, looking at other commodities, we'll talk a little bit about gold. Gold's down about $10 an ounce this morning to $17.42. Most European markets closed for the Easter Monday following Easter holiday in most of Europe. Some individual stocks in the news. Apple is joining forces with Alphabet to ensure the use of Bluetooth technology to help governments and health agencies reduce the spread of coronavirus. South Korea is going to ship coronavirus testing kits to the United States. Reports that up to 600,000 will be delivered to the United States after an appeal from President Trump. Amazon is not accepting new grocery customers amid surging demand. I think existing customers like myself who have ordered a couple of times didn't really see any ability to order anyway, but not accepting new customers. And interesting byproduct of the pandemic, and I think this is something to keep an eye on for U.S. markets, not getting a lot of attention, but I do think it's significant, is the coronavirus pandemic has slashed the cost for foreign investors that are seeking to hedge or neutralize their currency exposure of owning dollar-denominated assets. As those hedging costs have come down, it makes it a lot more attractive for foreign investors to purchase bonds here in the United States. If you're looking at negative yields in Europe, which you currently still are, even though our rates are extraordinarily low, they are significantly higher than their rates, and the same goes for Japan. And now you can hedge the currency a lot more efficiently because the costs have come down, so they are able to purchase our securities and without that currency risk being as much of a factor, because they can do that hedging, creating a lot more demand for bonds here in the United States on the taxable side especially. So something that's not getting a lot of attention. Do think that's very significant potential demand in the fixed income space as long as that hedging opportunity remains. So some general news this morning. Corporations want President Trump to open the U.S. economy. There's been talk about May 1st, but at the moment President Trump's saying that he's going to listen to health officials who are against relaxing social distancing measures, as new projections say deaths could reach 200,000 if restrictions are lifted too soon. The European Union announced a comprehensive economic policy to the COVID-19 pandemic, something that has been something that critics have been calling for as a more coordinated response out of Europe. UK Prime Minister Boris Johnson was discharged from the hospital after his fight with coronavirus. Dr. Anthony Fauci says areas like Arkansas can begin reopening next month, but other areas like New York City will take longer. That's according to CNN. Federal Reserve Bank President Neil Kashkari, as the Federal Reserve Bank of Minneapolis president, says the U.S. could face 18 months of rolling shutdowns without effective coronavirus vaccine or therapy, according to Bloomberg. The CDC is reporting that modifications and extensions of the no-sail order for all cruise ships could be forthcoming soon. Airlines out this morning saying they're not satisfied with terms of the government assistance, saying that 30% of the money will need to be repaid, and that they will need to offer approximately 10% stock warrants, according to Bloomberg. Also, Boeing in the news, and Boeing speaking with investment banks about financial assistance as it could begin talks with Treasury later this month. Intel CEO saying that he is seeing demand pick up due to work-at-home trends. J.P. Morgan is increasing standards for mortgages on concerns that consumers are not in as good of a place as they were previously. Macy's has hired Lazard to help increase its finances, according to Reuters. And an interesting story regarding the banks, J.P. Morgan, Wells Fargo, Bank of America, and Citigroup are preparing to become operators of oil and gas fields as they seek to avoid losses from defaults taking place in some of the operators here in the U.S., and they're out seeking to hire geologists and experts in the oil and gas industry so that they can, in effect, go into those businesses as they take over those assets instead of choosing to liquidate those assets at what some would deem to be fire sale prices. What do we have to look forward to this week? We're going to get earnings on Tuesday from J.P. Morgan and Wells Fargo. That's going to be Wall Street's first peek at how the decline of economic activity is affecting bottom lines of the major banks. On Wednesday, we get retail sales for March. Economists forecast a 6.4% decline. We also get Home Builder releasing its housing market index. That's expected to drop to 52.5 from 72. Also, we get the Empire State Manufacturing Index. We're looking for a minus 32 reading, down from minus 21.5. Also on Wednesday, we get earnings from Goldman Sachs, Citigroup, United Healthcare, U.S. Bancorp. Thursday, we get earnings from Abbott Labs, Bank of New York, BlackRock, Intuitive Surgical, Taiwan Semi. We also get new residential construction data for March. On Thursday, we get the Department of Labor initial jobless claims. That's obviously something that's watched keenly. So we start to get these earnings reports, and we'll get some sense of what effect the coronavirus is having on the economy. Again, this quarter, 2 months of what could be viewed as quote-unquote normal data, and then March when the coronavirus really started to impact corporations. So Barron's headline story was, "Get ready for a post-coronavirus world. The economy will never be the same." They suggest trying to picture what the world will look like after the coronavirus pandemic has been contained. They point out it will pass, but what waits on the other side is a great unknown. Already the pandemic is reshaping consumer, corporate, and government behavior. Long-held assumptions have been discarded. Deficit hawks have barely made a peep as policymakers have spent trillions of dollars to stabilize the economy. Universal health care and social safety nets, once deemed radical ideas, are getting more mainstream attention. Possible hints of what a post-coronavirus world will look like have started to surface in Asia. Sales at Chinese malls have recovered to about half of what they were a year ago. But what they are seeing in China is that home sales are rebounding. Also, we may see significantly more workers permanently working at least some days from home. We may see corporations reconsidering their sprawling office space and deciding that they don't need as much space if they have workers occasionally working from home. May see more shared office space as the world emerges in a post-corona environment. Good news for those who are commuting is we may see less traffic as a result of more people choosing to work a couple of days a week from home. How consumers fail, Barron says, really is a great unknown. If you go back to the Great Depression, what you saw after a traumatic event like that, which went on for many, many years, and this will probably not be as deep, but nevertheless, after the Great Depression and people discovered that they didn't have enough saved for a rainy day, the savings rate in the country jumped from almost 0 to 28%. Obviously, that has a significant effect on potential spending if we were to see a significant tick-up in the savings rate once things return to normal. In some polling that took place last week, more than half of Americans said that they had tapped savings or emergency funds, so they need to replenish that. And 63% of Americans said that they were worried about running out of money. Also, companies may change how they interact with customers. We're seeing one of the most successful models being Nike. Nike, for example, has seen a recovery in China stronger than most, and that's helped by keeping its stores clean, contacting customers via its app to educate shoppers about fitness and not just selling them sneakers. Also, we may see a change as people have been purchasing more items like groceries remotely, and not just younger, more technology-savvy individuals, but we have seen seniors being forced to navigate the online world and learn to shop for their groceries online. Potential beneficiaries are technology companies that help create the infrastructure to accommodate a more remote world, for a work-at-home environment. So this would be companies that not only manufacture things like computers, as people need more powerful computing power at home, but data security, network security, companies that make cameras, keyboards, as well as the opportunities in cloud computing, infrastructure for the cloud, 5G technology, which was something that we were very much looking forward to previously, becoming even more of a potential beneficiary of a world that emerges from Corona. Also mentioned commercial real estate as an industry that could have a hard time recovering, and certainly the travel industry, even once recovery begins to take place, and even if you get into a world where there's full recovery, vaccines, that type of world, we may still see less business travel than we were experiencing before, as people have gotten more comfortable with video conferencing. Also, we may see, at least in the near term, less leisure travel, as people, including Chinese, who are big international travelers, choose to stay home, avoid the hassles of travel restrictions, and a possible backlash against foreigners. Also, if you think about businesses, not just individuals, but businesses, possibly some have learned a very valuable lesson that managing business for the very short term may be a short-term strategy, and that they need to rethink their rainy day funds. After years of loading up on cheap debt, companies are apt to favor more cash. Sort of think of it like a traffic accident. After you get into an accident, you are much more aware of your surroundings. You react differently, and companies may have a whole different attitude towards stock buybacks and piling on debt, and maybe more focused on a healthier balance sheet. And the same goes for supply chains. Companies that relied on just-in-time delivery, that were very heavily dependent on suppliers overseas, may find that it makes not just economic sense, political sense, but a lot of business sense to have backup potential to manufacture in multiple locations, not just in one location. And finally, when it comes to government policy, we may see significant changes in the attitudes towards regulation. We saw the Trump administration being very laissez-faire in terms of regulation. It was something that the American people were very receptive towards. But now, post-pandemic, we could see a wave of regulation, things like increased safety measures at nursing homes and long-term care facilities. We may see things like more focus on health care and protections for the consumers in terms of health care. So you could see lots of changes there as well. Going to turn over to Brad in a moment. Just mention a few stocks that were mentioned in Barron's real quick, and then turn it over to Brad. You may have heard T-Mobile and Sprint finally closed their merger. Didn't get a lot of headlines. One of the beneficiaries potentially from this is Dish, D-I-S-H. Dish buying the Sprint Boost mobile prepaid brand. Regulators basically suggesting that in order to get that deal done, they had to divest that unit. Dish purchased that unit, and they have a 7-year deal with T-Mobile to operate that unit and use T-Mobile's network. Dish may seek to build out their network. They have 7 years to do so in order to move those customers to a network of their own. Dish does have the spectrum. Question on whether or not they can get the financing, but nevertheless, Dish potentially could emerge as a fourth participant in the wireless industry here in the United States. Also mentioned positively in Barron's is Facebook. Barron's discussing the fact that people have been using Facebook to communicate with friends and family during weeks of isolation, and when the quarantine ends, almost certainly everyone will post even more to Facebook and to Instagram and WhatsApp to share their post-quarantine celebration. Facebook has been a good corporate citizen, donating money and grants, which may help overlook some of their gaffes or lapses prior to the pandemic. So Facebook, Barron's suggesting, could emerge stronger as a result of their actions here in the crisis. Also, Barron's talked about Berkshire Hathaway. This market is made for Warren Buffett. Has he gone quiet? suggesting that we'll find out more, if not sooner, by May 2nd, when Berkshire hosts its annual meeting. That will be by a virtual annual meeting. And Barron's talks about the fact that Berkshire stock trades at 1.2 times book value, towards the low end of its historical range. And you've also got the benefit of knowing that they're sitting on a pile of cash and may be deploying it, or may have the opportunity to deploy it and take advantage of some of the market dislocation. Going to turn it over to Brad. Good morning, Brad.
Good morning, Keith. Thanks. Morning, everyone. Hope everyone had a great holiday weekend. Nice, long, relaxing weekend. Just a couple of comments to be brief this morning. One, I was telling Keith earlier, what's been keeping me up at night is that this move the last few weeks in municipals has been very much like the equity move. And municipals and equities seem to be trading hand in hand. So what I want to see is if the equity market were to correct at any point, if municipals hold as a safe haven, or if this is all liquidity driven. So that's one of the unknowns that we don't know yet. Once the Fed came in and said they are supporting municipals and everything else, obviously the market firmed up, and the old saying is don't fight the Fed. I guess these days you don't fight Goldman or some of the other big boys either, who are putting their necks out, I'm sure, in communication with the Fed. So the question really is, where do we go from here in terms of liquidity? The second thing is it's time to look at what you own in your portfolios. You have an opportunity, like people say in equities, and I'm not an equity person, but like people do say in equities, it's time to upgrade the portfolio. Every person that comes on CNBC says it, whether they're bullish or bearish. They all say, take a look at your holdings, and it's an opportunity to get into things that you're comfortable living with for a long period of time. In municipals, there is obviously volatility. If you're in the right bonds, at the end of the day, you get par. So that's something to keep in mind. Once again, I woke in this morning and we're back in a situation where you're looking at short-term rates on treasuries, high-grade corporates, municipals. In the short end of the curve, you're really back down to these very low levels again. Once again, you're going to be forcing money out in terms of maturity, and people are going to want to take risk because they're going to want to have better returns. My opinion, and it's just my opinion, is that I would not be tempted to do this at this point. If you are buying longer-term bonds, for someone who always buys longer-term bonds, that's a different story. But if you're buying longer-term bonds because you think that that's the only place you can be, I would heed caution and see where this market actually heads. Just give it a little while. I'm curious today to see if the municipal bonds continue to be chased at slightly lower yields than when we were before.
Thanks, Brad. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.